Okay, good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets Podcast. It is Tuesday, May the 17th. Oil prices are kind of looking for some direction this morning, nothing too profound, but nonetheless moving upward this week. And it would appear, although I don't want to speak out of class here, that they're attempting to break out on Brent, at least the sort of tight band of 100 to 110 that we've been sitting in so far of the last sort of the bulk of this conflict with the Russia invasion of Ukraine. After the initial surge to 140, they've settled back and have been locked in that. The question is today, are they breaking out of it? What are they going to break out of? But we can't speak to Matt Stanley this morning because he's put out a note saying he doesn't want to talk about anything. His market note this morning is, I don't want to talk about anything. So I'm going to start with the easiest question. What the hell happened to Arsenal last night?
Oh, look, that's the one thing that I really did not want to talk about.
I know, because you put it last in your note. That, of course, is going to be the first thing I'm going to pick up on. Arsenal don't have the bottle. That's the problem, Matt. They've all the dance, but they've no metal. Matt, have we broken out of the tight band 100 to 110? What is the trigger if we have?
I would argue that we haven't broken out of it. Nothing fundamentally has changed. We're still in this push and pull market between what is happening with EU sanctions on Russia and what's happening with demand concerns. Arguably, though, why we've broken above it this week, look, this time last week, Brent was trading at $101 a barrel. So it's been quite the rally in 7 days. I would argue that the market is starting to price in now that China will eventually emerge from this hibernation that everyone has been in, or the vast majority of them have been in, and there is light at the end of that tunnel, and demand will start returning. There's been some figures in this week that have been pretty appalling in terms of economic data, so that was putting pressure. And look, Hungary being the issue regarding the European bloc signing a deal, I think it's a matter of time. I don't think that it's not going to happen. It's going to happen, but they'll need to secure barrels from elsewhere. So I think that there's less concern regarding China and demand, and there's more concern growing by the day that the EU are going to do something, and the world will not have enough oil come Q4. And I wouldn't be surprised if we moved from 100 to 110, now 110, 120. And as soon as an agreement is reached, we could easily get way above that 120 number.
Let's go to Malia Bengali, founder of MB Commodity Corner. She hasn't moved to Venezuela where there's no electricity, but she is in a dark hotel room. But Malia, I suppose the darkness does correlate with the potential, with the question I wanted to ask you. You spend most of your time in the UK, or certainly a lot of it. The Governor of the Bank of England used a word yesterday that is somewhat chilling. He called food prices apocalyptic. Now, governors of the central bank are not known for their hyperbole. How should we interpret this?
You're absolutely right. In theme with the rolling blackouts, even Italy is talking quite a bit about them. I'm actually have this dark room. Apologies for that. But you're right. The mood in UK and Europe right now is very dire. Food prices, not only are they higher right now, there's also food missing on shelves. I recently went to a grocery store to get some items, and we can't get everything we wanted, which is quite interesting. The gas prices haven't really come down, but I think the oil market, you need to take a step back. There are three different macro issues that are actually affecting the oil market. We have inflation, we have macroeconomic policy, and the Federal Reserve that's prone to raise rates. But then we have a very tight gas market due to very different supply demand factors, which is very Russia specific and US specific. And the oil market tightness has actually been driven by the refining market. So it's all sort of seen as one sort of spectrum, but there are really different factors that are affecting it. But from the economical point of view, you're right. Consumer wages are not going up. Inflation is close to 8.5%. Your grocery bills are not coming back down, and your mortgage rates, your fixed mortgage rates are fixed, but your other mortgage rates are doubled. So the average consumer, whether it's UK or US, is feeling a massive pinch in their pocket. How will they grow or spend when you actually have that lower disposable income? It's a situation quite dire, and they don't know what to do because they cannot print their way out until inflation comes down.
Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, sitting in sunny Florida. Mike, is the outlook for the US economy rosy and sunny?
No, I think on a global basis, it's a domino effect. It's guaranteed we're going to have a collapse in Russia, a pretty good chance we're going to have a recession in Europe, and we see what's happening in China. These are things that some of us in our economists predicted from China for years. China's, yes, short term it's lockdown, but longer term it's pushing back on free market capitalism. And you look at their GDP, it's an end game. It's not something that happens organically. They pick a GDP and then they try to get to it, and they're failing at that. You look at demand from crude oil in China, it peaked 7 million barrels a day. It's declining. So I look at everything that's happening here as part of the great reversion in risk assets. The Fed is selling calls against risk asset. Every day that crude oil is higher and the stock market's higher, there can be more aggressive. And I think we're going to see a much lower U.S. stock market. We're going to see crude oil much likely to drop a lot lower. And I think gold is going to be one of the commodities that come out better from it. And the grains, as Malia mentioned, the grains are doing very well, and they should continue to do well until we can really define the supply we're going to get from Ukraine and from the U.S. The key thing to remember here is what's an unstoppable asset is the dollar. Dollar strength is bad for commodities. So I view this as just part of the beginning, and crude oil is a big part of it. And good indicators, copper. Copper is entered to lose versus China versus crude oil, even silver. So I looked at it from a broad commodity standpoint. The rule is, the higher price cure. There's just, as Matt and I mentioned earlier, right before on, there's just, from my standpoint, where I come from, the Midwest, there's just too many profits that are being made right now. And these things are usually unsustainable because when producers make profits, they bring on supply.
Matt, you think we're not breaking out of this tight band of we've been stuck in for some time now. What do you think would trigger it out, and which direction would it likely go? Mike signaling down, our ultimate bull at the moment on the weekly commentary. Omar at BB Energy signaling massively up. What's your own thoughts?
Well, you know me, I've been a bear for as long as I can remember, and I don't even want to use the term bullish.
But you're a bear wearing bullish clothing these years. COVID's put some horns on you.
I'm like Winnie the Pooh that's gone to a fancy dress party. It's really weird. But no, look, bullishness implies that people are happy about where things are right now, about the people are hungry and aggressive to get involved. It's simply down to the fact that there won't be enough oil. Now, I can understand what Mike is saying, and I have the same argument with a couple of other people as well, because recession is looming, and recession would always mean that, $50 oil by, say, Q4, that's not out of the realms of possibility in terms of the inflation and recession argument. But without enough oil, we could be in a weird world that's going through a recession with triple-digit oil. It's crazy. The one thing, though, that I will look at, and what really drove the gas crisis last year was, and the oil complex in general, because gas prices went bid because there wasn't enough of it, and diesel followed because that was the next feedstocks for power generation, what we needed. Russia supplied 49% of the EU's diesel. If that comes off the market, refining margins simply have no place to go apart from go bid. We're at $32 a barrel now on gas oil cracks in the EU. The 321 crack in the States is $53 a barrel. With less product being accessible by the EU from Russia, diesel, that will drive a rally. That's the end user demand. End user demand will still be there, recession or no recession. Tractors still need to move, and your daughter still needs to get to school. It's the biggest industrial use fuel in Europe. Benefiters of that, who we want to call them winners, the US Gulf Coast. I think that those refiners will do extremely well. But at the same time, they're not able to buy the high sulfur feedstocks they were buying from Russia. So they have to buy from other places. So Iraq will probably be a big winner. But again, I don't like to use the term winners and losers. There's only losers here, really. But I only seen it going one way. And it wouldn't surprise me if we saw 150 by August.
Maliha, does the Fed and by default other central bankers have any other tool, any other option but to try and kill this demand, this idea that I have to bring my daughter to school, Matt says? Is there any other way that is there any other option here other than kill demand, and hence we have to brace for massive rise in rates?
You're absolutely right. They really don't have any tools right now other than Joe boarding the market lower by talking much more aggressive stance on rates. They're hoping asset prices come down, so hopefully commodity prices come down and inflation's lower. Until inflation comes down from 8.5% down to maybe 4 or 5%, they will not be a trigger to move or ease policy. The market right now is hoping the Fed's going to reverse their policy, but they don't have the luxury or the flexibility to do so. The other issue is unemployment. Unemployment right now is very good and they're very happy, which is why they're tightening their stance. But if we start seeing this recession follow through, this weakness, and start seeing unemployment go up to anywhere here, then the Fed's again going to be caught up in a dilemma. So they don't have a choice. China's lockdown has helped take commodity prices down from copper, aluminum, nickel, oil, and there are a lot of conspiracy theories as to why they've taken such draconian measures. Having said that, the oil price is still very, very strong. And if China reopens again, we need to see what that demand uptick will be. And that's what the market's going to decide right now. But no, the Fed does not have a choice until something snaps. We've been saying that something has to break for the Fed to reverse their policy, or commodity prices need to come down. They cannot change their policy, and they're going to keep raising rates till something happens.
Malia, just to follow up on that China comment, pre-lockdown, this current window, we were already in a sort of a sort of space that was questioning China's economic health. Ultimately, the construction industry being the biggest sort of Achilles heel. Is this lockdown disguising some very structural weakness in, and there might be an overestimation as to how China could come back kicking on all fronts?
You're absolutely right. So our macroeconomic models have been picking up a GDP weakness prior to these lockdowns. China is their weakness, their GDP is a lot more severe than their numbers project. We know that we can't trust their numbers because there is no way to. The lockdowns have made it worse, but we don't know if the number is 2.5% or 4.5%. But the lockdowns did exacerbate the weakness. Having said that, they're trying to boost their GDP by boosting infrastructure spending and housing. Is the best way to get GDP up. But this is not like other cycles when China announces measures to boost infrastructure and we get a massive rally in commodities and copper and base metals. It's different because they're slowing down so much, they're hurting so much that this is the only thing they can do to support and balance out that negative GDP impact. So it's a bit different this time. But yes, we think the weakness in China is a lot worse than the market expects. Eventually, the credit impulse is going to pick up. But the question is, how much is your neutral GDP? It's not 6.5%. It's not 1%. It's somewhere in the middle there. But you are right. The lockdowns have masked something that was already weakening from before going into this.
Mike, the big question I think emerging, I mean, has already emerged perhaps, is what is the sort of resolve of the Fed, of Jay Powell and his colleagues to face this inflation challenge? Even Ben Bernanke is criticizing the Fed. When the ultimate dove, Ben Bernanke, is criticizing you, you're in a bad place. What's your outlook for the Fed's appetite for this battle, this Volcker type scale battle?
That's the key word, is Volcker, a key name, Sean. Melly mentioned it. And don't underestimate the resolve of the Fed at this standpoint, because in the last press conference, Mr. Powell mentioned Volcker a few times, and Volcker is known as creating a recession in the early 80s to squash inflation. It's successful. At the time, there was a lot of hate for him. Now people love him. And don't underestimate, it's going to happen. So my theme for this year is don't fight the Fed in risk assets. Now that's playing out with one key exception, and most notably commodities, which is good for commodity people, but it makes it worse. When people say $150 crude oil, that's virtually guaranteed global recession, which is if we do it what we did last time, which I fully expect we do, then it goes back to 40. And a key thing I like to ask people is what changed for the supply-demand situation that was really pushing crude oil, keeping it well around 50 before COVID. And the key thing that's changed is human ingenuity. Now, remember, this is it's society that created vaccines in less than a year. And most of the world's vaxxed now if we want to be. And now I just enjoy that narrative when people tell me, oh, we can't come up, bring on supply, reduce demand like we did before. And I just look at the best example in history is the US. Liquid fuel demand in the US is the same as it was 20 years ago. It peaked in 2018. It's heading lower. Yet supply is increasing rapidly for one key reason, rapidly advancing technology. And that's spreading out through the world. Biggest sales now in cars are EVs, particularly. It's just kicking in this country. In China, it's kicking in, just a matter of time. And then I look at the way overdue recession, and one key little technical indicator on a 100-week moving average. Crude oil just recently got its highest ever. 200-week moving average, the highest ever. bond yields, the highest ever. Now, when I can say that, and I go back 60 years, which is a bit older than I am, my thought is there's a trade here. My trade is trade for the revision. My job used to be structured option positions. Okay, maybe you lose a little bit. When you're right, you make 10, 50x.
Matt, 60 years is nearly the last time that Arsenal and perhaps Man United both were competing for the Premier League. But what has triggered this sudden, it would appear, sort of supply crunch, the capacity crunch in refining? It's been a long time coming, but it's suddenly in the headlights. It predates Ukraine, Russia, all of it. China could certainly do something to help with its refineries operating at way less than capacity.
Yeah, that's a very good point. Not the Arsenal one. That's the last one. I'll let it go. But yeah, the Chinese refining. You're right. Look, if we take the way that the market trades on gas oil, I'm referring to gas oil quite a bit today, is what we refer to as the East-West. So it's the difference between the price in Singapore and the price in Europe. Now, that has reached this year so far minus $100 a ton to plus 20. And it's usually within a $20 a ton range. It's simply, Sean, that arbitrage economics cannot be priced in because no one really knows what's going on because the world is so fractured. So people can get to work in some Chinese refiners, but there's no one really trading those barrels for them. So they're not able to take advantage of where the demand centers are. It's a messed up world. And Mike said something about the $150 oil argument. And again, I come back to this. I've had this same conversation with a few people. I understand that as soon as recession hits, crude oil prices have to come off. It does follow a pattern. When we hit $147 in 2014, it quickly came down. I can't apply anything in my 22 years experience in the oil market to the supply issues that the world has got right now. Fundamentally, economically, Mike is right. But there is nothing I can say in terms of supply shock that doesn't make me think that oil is going one way and the world economy is going the opposite. It should follow, it should be linear, but it's converging, it's crossing. But in terms of where China are, look, again, Aramco, they're exporting a lot to Europe, a lot of diesel, so are Reliance. I think it's a matter of time before we see China ramping up. Look, demand is arguably, it's the season now coming into sort of July deliveries from China. There's not a great deal of demand for gas oil, but there will be in, say, 2 months' time when people will start looking at stocking up for winter. So I think that you will really see the Chinese start ramping up aggression when it comes to selling the products out of these shiny new refineries.
Malia, we've got Sri Lanka announcing today that they're literally out of petrol, out of gasoline. The country will slowly grind to a halt. We've had reports that even in the east coast of the United States, you could see shortages this summer. Where is there a solution? Is there one to ease this stress? We obviously, on crude, we could release SPR and try and ease things, at least ease prices. But in terms of supply on middle distillates, is there any solution?
You're absolutely right. As Matt very correctly pointed out, this is really a timing issue. You know, in the short period of time, you're about to start the summer driving season in the US. If we do not forecast a recession, summer driving is deemed to be the same as the last few years, where this pickup in demand will put much more pressure on the gasoline market. So in the space of 2 to 6 months, we really don't have a lot of diesel or gasoline right now. Now, the diesel distillate market comes more into play in the second half of this year, more on the manufacturing side, the trucking side, but gasoline. So US refiners right now are probably maximizing production or looking to maximize production because they've never made such record profit margins. But you still have a shortage around the world because of rerouting problems, supply chain problems. We need more refineries to ramp up. So until refineries ramp up production and we actually get more products on the market, this market is still going to be tight from the product side. Having said that, it'll take about 4 to 6 weeks to see exactly how much of this China slowdown, US and Europe slowdown is going to affect trucking and manufacturing. So there are sort of two moving parts right now. But Biden releasing more oil or even Saudi Arabia releasing more oil is not going to solve the problem. The problem is just in middle distillates. And that is what we need to talk about. The other thing is jet fuel demand. If the economies are opening up, if you start seeing an increase in travel demand, then that will take a further pressure or put further pressure on the product market. So the solution is in refining, and we are waiting to see how that plays out.
Mike, are you a subscriber to the stagflation argument at all? I mean, it does seem it is the emerging, headline as such.
It's a short-term thing, and I do enjoy how people, and the thing you learn about commodities, you buy low, sell high. It's not like stock market, you buy high, sell stock higher, which has been the case for 10 years. That all changed because of inflation. But remember, people are measuring inflation on a 12-month basis. Take a look at a 120-month basis. It's very bearish. It follows U.S. bond yields. And I look at the spike in bond yields and the spike in crude oil as some of the best opportunities in the enduring long-term trends that are more enduring. They've been lasting longer, and that is the ability for people to create more liquid fuel at a lower cost and actually use a lot less. And that's been, the U.S. has been the best indication of that. So I fully expect that to kick in. And a year from now, remember, it's the base effect. We're going to be measuring crude oil on a 12-month basis for $100 a barrel. It's going to be lower, virtually guaranteed. We're going to be measuring PPI. It's the same thing on a 12-month basis. It's almost guaranteed to be lower, particularly because the Fed needs it to do that way, and the Fed will keep raising rates till it has. So here's a key barometer I look at. You look at Fed fund futures a year from now, they're priced around 3%. That's still above the bond yield, and that's 120. It's well above 120, about 125 basis points above the current rate. That rate has actually started to come back a little bit, and that's what happens every time when you get these inflection points. Crude oil is a key part of it. And I think that's a key thing I'm watching. So I think one of the best commodities to be involved in for this time next year is gold.
Let's go to the survey question and give everybody else in the room a sense of expressing their views on this topic. Crude oil markets have been paralyzed by the loss of production from Russia, matched by loss of consumption from China and Europe. What is most likely to be the catalyst for a breakout? China to unlock its COVID restrictions, an EU-Russian embargo, both of those things you would think could be bullish. Inflation, recession, which is all on the headlines now, including by Ben Bernanke. None of the above. Which of these do you think is the catalyst for a breakout from this 110 to 100 range? Although we are trading on Brent closer to 114 today, are we already seeing a breakout on these headlines out of China that you can go and buy a Starbucks, but still 40 plus cities in the country under lockdown? So your vote here, China to unlock, EU-Russia embargo, inflation, recession, which one will be the catalyst for a breakout from this tight band that we have been trading over the last number of weeks? Matt, looking forward, we had some big comments by Saudi oil minister yesterday. He speaks every now and then. Yesterday's comments seem to grab the headlines on the fact that Saudi will be raising their oil output capacity to over 13 million barrels over the coming few years. Anything else that grabbed your attention there that the market should be paying attention to?
I think, what Saudi have done recently is highlights the fragility and the fractured state of recovery the world is in, is what they've been doing with OSPs. They took them back down to barrels that are going into Asia and into Europe, but kept them high for barrels in the US because refining margins over there are so good. So I think that what the world will look closer and closer at OSPs and what they're doing. Refining margins, Aramco, like I said, I'll go back to the diesel argument again, but it's across the barrel. Naphthas, gasolines, distillates, everything is looking better and better. The higher the prices get, look at the Aramco Q1 results. I mean, they're extraordinary. So look, whether they're
that's just the price of oil, isn't it? At the end of the day, is there anything more extraordinary than that?
No, it's refining margins, Sean. You think this time last year it was say $10, $12 a barrel for gasoline cracks. They're triple that now. Of course, prices are that much higher as well. But it's as you said this morning on the radio, you said what Aramco are doing is leading the way in terms of how efficient they are when it comes to the cost of production. So I think that they will continue to be the leaders on that. I think ADNOC will be the same. Like I said to Mike before we started the call, that part of the world that is absolutely booming at the moment is the Middle East. And that's down to high energy prices. I think gasoline margins... And
Russians with suitcases, maybe.
Well, you said that, not me. I think gas oil margins continue to climb, continue to stay as high as they are. And I think that the benefits of that, well, like I said, will be the Gulf Coast refiners and especially Aramco, the refineries out of the Red Sea heading up to Europe later on in the year.
Maliha, the markets, it seems obviously the equity markets, the financial markets are showing us the direction forward. They are all imploding, you would say, to the extent that is it beyond a correction? It looks like we're moving from correction to from bear to collapse nearly. Some would indicate that maybe it's reaching its bottom. But ultimately, will the commodity markets follow the equity markets? We've had a kind of a 2 years of all boats rising in the upward motion. Will we have it the same in the downward motion? And I'd welcome your thoughts on the answering that, the impact of the Fed decision, not so much to raise rates, but to pull back quantitative easing to offload their balance sheet and the impact of that.
Thank you, Sean. Well, see, our debate has been that for the last 10 or 12 years since Fed launched QE, the focus on the market has been technology stocks. The questions we get from our clients every day is not to buy commodities, is when do we buy Amazon, when do we buy Apple, when do we buy technology? But this is not just a correction. Take a look at the analogy from 2008 or 2001. This is a proper bear market. Technology stocks have only benefited in this environment, we feel, because of the Fed QE. You had a massive sort of long duration asset pool, which has helped these technology stocks. Fundamentals do exist, but let's look at ARKW and all those speculative funds. They're down 80 or 90% right now. So the question is not when do we buy technology, because that is not going to go up until the Fed eases back on tightening rates. It's just a duration play on the bond market, right? Taking a step back on that, the Fed, as we said, cannot really reverse their policy till inflation comes down. They will lose all credibility they have. They have very little left anyway, but they have to keep going as they do. Perhaps another 50 basis points, perhaps even 75. We go vocal. We do not know. But right now, the next data print we get on June 12th for the May CPI and PPI is going to show a very sort of heightened trend. The inflation has not come down. So until that comes down, we will not feel that reprieve from the Fed's point of view. And until that happens, the market's going to be debating between this growth versus value trade. Right now, the market's putting all the money in energy stocks and value names like oil right now, taking the money of technology. And I think that sort of sector rotation is what the market's focusing on. But this is a proper, like, it reminds me of 2008, where how long can the energy market, all the sort of distinction stuff from the other market, if we get recession, eventually other commodity markets should follow, as we've seen in copper and aluminum, another nickel for as well. And that's a big debate. Do we get a slowdown or do we get a massive recession? And the time will tell, and data is going to tell us if that's the case.
Let's go to the survey result and give Mike the last word this morning. Okay, a spread across the room on exactly which might be the catalyst. Pipping at inflation, recession, EU, Russian embargo. Mike also caught in all of this in the US and the direction of the US, perhaps, which of course is the biggest economy in the world and going to guide us a lot. I mean, it's the last pillar standing at the moment, it seems, as it was the first pillar out of COVID. Elections coming up, with the outlook for the US economy, where do all of these things synergize around politics, which is very much in the headlines now?
Well, let's start with the leader of the world's largest energy producer has a vested interest in the price of energy going down, so he gets reelected. You don't think he's not going to do something about that? So let's just focus there. We have a Fed Reserve chairman who needs a recession to reduce prices, so he'll be able to do that. And as Millie mentioned, we have the stock market actually was the most extended on most measures of GDP, sales, global basis ever. That's just starting to reversion. I like the term you use, proper bear market. We are so overdue for just a 1/3 correction in stock prices. Take back everything from the rally we had post-COVID, which was part of the biggest boost in money supply and liquidity ever. So I think we're beginning this great recession, great reversion in risk asset prices. Condos in Miami, land in where I'm from in the heartland going up 40% on a 2-year basis. It's just going to come back. Those are signs of peaks. Crude oil is part of that. Crude oil is helping spark it. And I think we're much greater risk at doing it in 2008 when we went up to 145 and ended up 40 than going to 150. And that's a lot of it's going to be predicated on the proper bear market and stock market, which needs to be happy to do because Fed needs to be able to take away the ability for people to buy stuff. A stock bear market does that. Everything should follow.
And just to pick up on that, Mike, as a sort of a slightly cheeky question, I mean, very few people in Wall Street have familiarity with trading markets like this. I mean, they're used to the welfare supplied by the QE and just everything goes up. Where's the expertise, do you think, and what is the consequence perhaps of the absence of that in such a critical moment? Experience.
There isn't. A lot of it is the world that people have been so accustomed to. Don't fight the Fed. Well, that means you're not supposed to be long risk assets. They haven't realized that yet in the big picture. It's happening. But from the kind of the inside scoop, when you've been on Wall Street for 30 years, like I have, you've sensed what's happening is people are selling stocks and rallies, buying 2-year notes and bonds, preserving capital. And to me, that's just accelerated. And most people who are astute and get into space, and you're hearing it trickle down every day, understand that, well, the last time we had a peak in the stock market, it lasted for 13 years. This one's been 6 months. Add a couple of zeros to that. We're way overdue for years of what happens in commodities. When you bullish commodities, I say, well, why are you bullish crude oil? That's at the same price it was in 2008. There's a reason for that. Because, and why does the SPR in the US doesn't matter anymore? Because we produce more energy now than we consume. Because of advancing technology. So that's going to hold up in the long term. In the meantime, this is the great reversion that's way overdue. And the Fed is going to make it happen. It's just the way it's always happened. If don't fight the Fed. If you're wrong risk assets or wrong crude oil, you're fighting the Fed.
Well, Brent crude oil during our conversation, maybe because of our conversation, has popped into positive territory. When we started, it was minus 50 cents. Now it's nearly positive 50 cents. The fundamentals from my point of view, I think at times like this, one has to keep a focus on. Global oil inventories are way below 5-year averages. The SPR in the US is way down. There is supply constraint in a lot of places. Putting aside all the noise about Ukraine and Russia, the investment into new capex is clearly still way below historical trends. So there's many reasons fundamentally why oil prices should stay afloat, given, but a massive recession perhaps knocks out GDP and demand. But ultimately, there's some very fundamental pieces there that keep oil prices propped. But what's the prop price? Probably 80, not 100. Anyway, that's my thoughts today. Matt Stanley, as always. Arsenal will be back. Don't worry. That's the way it is. Spurs will get it next season. But hey, come join us at Man United. Mid-level, mid-table, mid-table, baby. It's the only place to be. Maliha, thank you as well. Always, Mike, great to get your insights. Thank you. Have a great day. We'll catch up every morning, 10:30 UAE time. All the best.
Thanks,